I'm going to backtest the LCE model in real time and walk you through every single trade, start to finish. No cherry picking and no perfect examples. Just a full raw week of trading exactly how I trade, what I'm looking for, what I'd take, what I'd skip, and why. And the point of this is showing you how to think in the moment, how to stay systematic when things aren't obvious and your brain wants to force a setup. And once you see the system play out over and over, it gets way easier to trust it. You stop second guessing, you execute cleaner, you get better results, and that only builds more trust. It's an upward spiral, and it starts from there. So let's get into it. But first, a few ground rules. Every trade has to follow the LCE model: level, confirmation, execution. If it's not a level-to-level trade, I'm not even looking at it. If you need a refresher on LCE, I'll link some videos right now. I only trade regular market hours, 9:30 to 4 Eastern, and honestly, I'm usually done before noon. I'm only taking breakout trades, not mean reversion or anything mid-range. And risk is the same on every single trade. No sizing up, no sizing down. We'll be backtesting ES futures, and the most recent week at the time of this recording is January 26th to January 30th. And just a quick disclaimer, none of this is financial advice. I'm just showing you what works for me. Use it at your own risk and size properly. All right, let's get into Monday. So here we're on the 1 hour just before the market opens. The first thing we need to do is get our higher time frame bias using the cloud. In this case, we see that the 1 hour cloud is pretty flat. It was bullish recently. Then the price started consolidating and chopping sideways, so the cloud's momentum followed that too. So now we're flat. Our bias for the 1 hour cloud is neutral. Then if we go down to the 30-minute, we see the same thing. The cloud is flat. And if we go down to the 15, we'll see the same thing. And then if we drop down to our execution time frame, on the 5-minute, we see that the cloud is flat there as well. So all clouds on all time frames are flat. That means we don't have a bias. And that tells us two things. One, the market is more likely to range than it is to break to the upside or break to the downside. The same way, if we're in an uptrend, the market is more likely to go up. And if we're in a downtrend, the market is more likely to go down. Well, in this case, the market is more likely to continue doing what it's already doing as well, which is ranging. So that's the first part. The second thing is, the market has an equal chance of breaking to both the upside and the downside. And if the market does break to either of these sides, we want to be sure that it firmly breaks through the level. Because remember, the most likely outcome is a range. That means a breakout is less likely, and we need some really strong evidence that the price will break out in that direction. That usually means placing our alerts towards the edge of the levels rather than the middle. So now, we just place our alerts at both the upper and lower levels and wait for one of them to get hit. Then here, the market quickly shot up to the upper level. So bulls are clearly in control, and therefore we're looking for this momentum to continue to the upside. The price is pushing the edge of the level, so we know that bulls are serious, and it's much less likely to just collapse back into the range. So we enter long. We're going to place our stop near the middle of the two levels, under market structure where it's safe. If the price decides to go all the way back down here, it means the move is likely invalid and we'll just continue ranging as we did before. And we're going to place our target at the next level. Then we simply wait. And our target got hit. It did take a while. We were in there for about 4 hours, but the trade still ended up working. This is what's key when it comes to taking a level-to-level trade. As long as your thesis is correct, it doesn't matter if it takes 5 minutes or 4 hours. It will move from one level to the other, and you just need to be in there to collect. That's our one win for the day, which is all we're looking for. So we can stop trading here and move on to Tuesday. Once again, we're starting at the 1 hour to establish our overall bias. And just from a quick glance, we can see that the cloud is very clearly bullish. It's sloping up, and this is supported by yesterday's move. So the structure is clearly bullish as well. Now let's go down to the 30 and see what that looks like. And the 30 is bullish as well, although starting to flatten recently. That may or may not mean something because it could just be a consolidation, but nevertheless our bias on the 30 is bullish. If we drop down to the 15, it gets a little more flat, which is interesting. It doesn't necessarily take away from the bullish bias on the higher time frames, but it tells us that maybe short-term momentum is slowing down. So our bias for the 15 is neutral. And if we go down to the 5, we see the same thing as the 15, which is very clearly flat. Our bias for the 5 is neutral. Now we have the bullish bias of the 1 hour, the less bullish bias of the 30, and the neutral bias of the 15 and the 5. So our bias is slightly bullish overall. And that doesn't mean the bullish scenario won't play out, but we should pay closer attention to what happens. Now we set both of our alerts at the upper and lower level. Since our bias isn't super clean, we want to set them more toward the edges of the supply and demand levels, rather than near the middle. We want to be confident once a level breaks. So once we have them both set, we simply wait. And here, the upper level hit. Price is looking bullish, and the cloud is starting to catch up as well. In this case, we can enter long. We place our stop under market structure around the middle of the level, and we place our target at the next level. Then we sit back and wait. And we see that our stop got hit here, which is interesting since our bias is bullish and everything pointed in that direction, right? Well, number one, not every trade will be a winner, even if it's in the right direction and with the right bias. The market doesn't guarantee you anything, and you should expect losses as part of your system, no matter how good your system is. But let's look at the reason why this specific trade didn't work, so we can learn from it. First thing is that it didn't actually fail as a move. It didn't reverse and drop back down to the previous level. It simply consolidated, and we got chopped out of that consolidation. Actually, if you look at what happened later, you'll see that the price did end up moving to the next level and hitting our target, although this happened overnight, long after the market was closed. So the higher time frame bias was correct overall, since we did get bullish continuation. The issue, as we saw before, was our short-term bias. The price was simply not developed enough on the 5 and the 15 to have a multi-level move today. Now, what's key here is not to overthink this and over-optimize it. If you took this trade, you would have taken a loss, and that's completely fine. You didn't do anything wrong by doing that. You can't expect every trade to be a winner, but you also can't expect to avoid every bad or wrong trade. In the end, consistency matters more than anything. So the two possibilities today with LCE would have been either going long at this level and probably taking a loss or a break-even trade, or doing nothing because your alert was either too high to get hit or didn't feel like the right time to enter. But either way, as long as you followed the system and didn't trade outside of the system or break rules, you're doing just fine. Let's move on to Wednesday. Now, on the 1 hour, we see that the cloud is still bullish overall, but recently started flattening. We also see a double rejection at the highs, so we need to be more cautious here. It could just mean that the market is consolidating and wants to move higher, but we need to be paying attention regardless. So our bias here for the 1 hour is lightly bullish, or neutral, but not strongly bullish because of the recent flattening. If we wanted it to be confirmed bullish again, we would need to see it bounce off this cloud and break above the upper supply level. That would confirm uptrend continuation. So let's drop down to the 30 to see what that looks like. And we see that the 30 is flattening as well. Let's drop down to the 15 now and see if it's similar. And the 15 is also similar to the 30 because it's flat as well. And finally, let's drop down to the 5 minute. Now the 5 minute here is also flat, but maybe starting to get a little bearish. So in terms of overall bias, we have lightly bullish as well as lightly bearish, which basically means we don't have a clear bias, and we're neutral. We can expect either a bullish or bearish outcome, and we don't need to have our bias geared toward either side. Now we set our alerts at both the upper and lower level, and we want to set them deep into the level as usual since our bias is neutral. Then we wait. And something interesting happens here, which is that neither side gets hit for the entire session. So if you followed LCE and didn't check your chart until you got alerted, you would have never even looked at your chart. You would have just gone about your day. Pretty great, isn't it? We're not involved with any price action that we choose not to be. I mean, imagine having to stare at this all day. So Wednesday was a no-trade day. Now let's go to Thursday. Starting with the 1 hour, we see that we're slightly bullish, or maybe just plain flat. Either way, not a strong bias toward either side. And that seems to be the theme this week. So our bias on the 1 hour is neutral. If we go down to the 30, we'll see the same thing, which is a flat cloud. And if we drop to the 15, we'll also see something similar, with our cloud still being flat. Now once we drop down to the 5, we'll be seeing the same thing, which is a flat cloud and non-conclusive price action. All the clouds are flat and therefore our bias is neutral. So as usual, we set both of our alerts at the upper and lower level, and we want to make sure they're deep into the level. Now we wait. And we see that the price dropped quickly into the lower demand level. Now, in real time, you would have probably got alerted, went to your chart, and entered pretty quickly. So you would have had an entry near your alert or maybe a little bit lower. And that would have been to go short, of course. Our stop is above market structure as always, and our target is at the next level. Then, we make it play out. So our target got hit pretty quickly. That's one clean level-to-level move for the day. Now, if you missed this trade for how quickly it moved, you had another opportunity not long after. This trade is still valid because our bias is still the same, and momentum is still extremely strong. So that was our second opportunity. There were more opportunities later on because this was a particularly volatile day, but just remember that the best moves are the initial ones. And once we move 3 or more levels, it gets riskier. This is because if we move 3 or more levels, that represents just a few bars on the hourly chart, and the 1-hour cloud can't catch up that quickly. So we're getting further and further away from the 1-hour cloud, and it's bound to get overextended and snap. It might not happen for the first 1 or 2 moves, but after that, it increases exponentially, so be careful. So that was for Thursday. Now let's move on to Friday. And by the way, if you're watching this and thinking, okay, this makes sense, but I want help actually applying it to my own trading, that's exactly what we do inside the LCE Accelerator. You'll get direct access to me through weekly calls and a private one-on-one chat, so you can ask questions and get feedback on your trades anytime. You'll also get this exact level-to-level chart, and you'll be part of a private community of traders and a live trading room. If you're interested, the link is below. On the 1 hour, same procedure as usual. We have the cloud that was recently bearish, although now starting to flatten. So our bias here would be either mildly bearish or neutral. We don't have a strong bias toward either side here, just like we haven't had one all week. On the 30, the cloud is flat as well. It's starting to sort of curl up actually. And on the 15, the cloud is also flat with the price above it. And if we go down to the 5, we see that the cloud is indeed flat as well. So once again, we don't have a bias toward either side, and we can expect a breakout in either direction. We're going to set our alerts at both the upper and lower level, and make sure they're deep into the level. Then we wait. Now, interestingly enough, the price attempts to break higher 3 times, but fails. Then it starts to dip lower. Later on, our lower alert actually does get hit. So in this case, you'd enter short with a stop above market structure near the cloud and your target at the next demand level. And in this case, our target didn't get hit, but the price did drop down to about halfway to our target, which is a sign for us to go break even. So for this trade, following proper LCE protocol, we would have gotten stopped at break even and then waited for another opportunity at this same level. That means setting our alert at the bottom of the level once again and waiting for it to hit. The key here is to be patient and not jump in at any move, because later the price does get hit and we can re-enter short again with the same stops and targets, and this trade ends up working. And that's our one winning trade for the day, so we can end the week here. That's how you'd trade a week like this with the LCE model. Now, if you want to start trading this way, be sure to check out the link below to join the LCE Accelerator. And if this video helped you, let me know by leaving a like and subscribing, and I'll drop more videos like this. I'll see you in the next one.